Hello everyone and welcome back to Financially Fluent. I am your host, Jacqueline Mutuma. So in the next 10 minutes or so, I'd like us to look at the next investment that we have here in Kenya, and those are unit trusts. So unit trusts are also known as mutual funds, and what these are, they are pooled investments from different investors. And when I say different investors, I mean you or me. So pooled investments from different investors, and then these resources rather, are invested in assets such as real estate, bonds, or stocks. But then the investment in itself, it is managed by a professional fund manager. So in short, it is different investors, as I said, like for example, you and me. Our resources are pooled together, and then a professional fund manager, we use the expertise of a professional fund manager to manage that account. Okay, so instead of us researching ourselves and having to manage these accounts by ourselves, we have a professional team or a professional fund manager to do that for us. And when I say about an investor, do not start thinking like you need 1,000,000 shillings to be an investor. No, an investor is you with your 500 bob, you with your 1,000 bob, me with my 500 bob. When our resources are pulled together and then they are invested in, let's say for example, something such as a bond, because for a bond you need a minimum of 50,000 to be able to invest in a bond. So what happens if you do not have that 50,000? That is why we have unit trusts. They pull these resources. They pull your money, they pull my money, they bring all this money together, and then a professional fund manager manages that account. So depending on the amount of resources that you have invested, depending on the amount of money that you have put into that account, you're given units that correspond with the amount of money that you have invested. And when the returns when the account yields returns, you are also given your returns based on the amount of units that you have. Okay, so the higher the units you have, the higher your returns. And we have four major types of unit trusts in Kenya. I'll start with the low risk, low return, and that is a money market fund. We all know what a money market fund is. So a money market fund invests in low securities such as treasury bills and fixed deposits. Currently, money market funds offer a return of about 9 to 12% annually. And then, as we have been speaking about money market funds, and we said money market funds are good for short-term goals, maybe goals that you need to accomplish in less than an year. They're also good for emergency funds. Yeah, so one example is a money market fund. An example of a unit trust is a money market fund. The other example is a fixed income fund. So a fixed income fund is slightly higher than a money market fund. The returns are about 10 to 12%. They are good for medium-term goals, let's say for example 1 to 3 years. And fixed income fund, they invest in assets such as bonds, also treasury bills, or in short, treasury securities. These are treasury bills and treasury bonds or treasury notes. Okay, and then the third example is a balanced fund. And a balanced fund personally is my favorite unit trust. This is because, as the name says, it is balanced. So you're investing in stocks, you are investing in bonds, and you're also investing in the money market, all under one umbrella. So that is the definition of a balanced fund. The returns are a bit higher than for a money market fund and a fixed income fund, but slightly lower than equity fund. Okay, but in terms of risk, it is slightly riskier than a money market fund and a fixed income fund. So the balanced fund is good for medium-term goals, and the good thing with a balanced fund, if the stocks go down, at least the bonds will pick it up. And because stocks are high risk, high return kind of investments, it gives a balanced fund that privilege of having a good return. So a balanced fund return may range from 13 to 15% per annum. That is pretty good. So that is another example of a unit trust, a balanced fund. And then the fourth example is the equity fund. And the equity fund, it invests in different stocks or shares of different companies. So an equity fund obviously has the highest return, but also it has the highest risk. An equity fund, the returns may go up to 15% per annum, but remember, you're investing in companies' stocks or shares. So if the company performs well, that means your returns are good. If the company does not perform well, then there's also that risk of you not attaining a good return, or rather even having less than what you invested. Okay, so if we arrange those four types of unit trust from the highest return, from the investment that has the highest return, we will start with an equity fund, and then a balanced fund, and then a fixed income fund, and then a money market fund. Remember, money market fund is good because of liquidity and for any short-term goal that you may be aspiring to achieve. Okay, so let's see, if you want to start investing in a unit trust, what is the process? What are you supposed to do? So the first thing is you need to pick a fund manager. So that means you'll have to go to the Capital Markets Authority website and look at all the licensed fund managers, and then pick one that suits you, that you see you can work with them. So the first process is you picking a fund manager. The second process, you have to fill in the application forms. And in this digital era that we are in, almost sure all of the application forms can be filled digitally, that is online. But if it is not possible, you can also visit their offices, their physical location, and fill in the application form. And then number 3, you have to obviously provide your ID, your KRA PIN, your passport photo, and bank details. Okay, those are the 4 very important details that you'll have to give when you're opening your account. And then number 4 is after you've done all that, you've opened your account, then you have to start investing. So you'll either send the money via M-Pesa or using your bank, whichever is suitable for you. And then number 5 is you receive units, and you start earning returns. All right, so what are some of the advantages of a unit trust? Number 1, we said liquidity for the case of money market funds. There is diversification in the case of a balanced fund, because remember, a balanced fund is investing in stocks, in bonds, and in money market. So there is the aspect of diversification. Another advantage is low starting capital. So remember, when I started, I said a unit trust pulls the investments of different investors together, and then that account is managed by a professional team or a professional fund manager. So if you want to invest in stocks and you don't have the money for stocks, or you want to invest in bonds and you do not have the money for bonds, that money that you have, you can open up a balanced fund, and then you join hands. It's like different investors, we are collaborating, we are joining hands, and then we are leaving it to a professional fund manager to manage that account for us. And depending on your investments, you get your units and the corresponding returns in accordance to how many units you have. So another advantage is it is professionally managed, so you can relax because you don't have to do the research yourself. You do not have to manage the account yourself. You do not have to be there worrying, how are the stocks performing? Are they going up? Are they going down? What are the current bonds rate? The professional fund manager manages that account for us. as investors, okay? And then number 5 is obviously access to high return assets without needing large amounts of money. And number 6 is passive income with low effort. So as with any investment, if there are advantages, there are also disadvantages. And what are the disadvantages of unit trust? Number 1 is there is obviously management fees, which ranges from 1 to 2% annually. And then that obviously reduces the returns that you anticipated to get. So if you knew you're getting a return of 12% on your investment, and there is a 2% management fee, so that means your return will reduce to 10%. The second disadvantage is that the returns are not guaranteed, and this is true especially in equity fund or balanced fund. The returns are not guaranteed, and I mean there's practically no investment that has like 100% return, like guaranteed return. Even a money market fund, in as much as we say it is a low risk investment, the returns are never like 100%, okay? So the third disadvantage is there may be delay in withdrawals. This is a very big maybe. Delay in withdrawal, and this may be in the case of equity fund, but it usually takes, let's say, a maximum of 5 working days. So if you need money for an emergency, like immediately, there might be that delay, because even for a money market fund, you need to give them about 24 to 72 hours so that you can be able to have your money with you. And then number 4, if the inflation is high, then it affects your return. If the inflation is at 6% and you're getting 9% from your investment, that means your money has only grown by 3%, okay? And then number 5 is there is limited control because the fund manager manages everything. So you just have to put your investments and then leave it all to the fund manager. If you have a good fund manager, well and good for you. If your fund manager is then that might be a little bit disadvantageous for yourself. So with that, I'd like to leave it at that. I hope you've understood what a unit trust is. If you have any question, remember to leave it at the comment section and I'll be sure to get back to you. And yeah, so in the next video, we move on to the next investment that we currently have in Kenya. Remember, I said we'll start with the simpler investments as we get to understand what these simpler investments are, and then we gradually move to the more complex investments such as the stocks and the real estate. I know that is what you are waiting for very much, but we will get there one step at a time, okay? So that's it for today, guys. Have a lovely day. Bye.